Hey everybody, welcome back to the Blockware Intelligence Podcast. Today we've got a very special guest, someone I find very insightful and someone I look for guidance in a lot of ways. We got John Wick here. John is somebody I met through, I think we met through Twitter Spaces, if I'm not mistaken. But yeah, how you doing, John?
Hey, Will, good to be here, man. Glad to be on your podcast.
Yeah, we've kind of been talking about doing this for about 2 or 3 weeks now. So I'm glad to finally get you on. Just for listeners, if I sound a little stuffy, I'm getting over a cold, so I might sound a little nasally. But yeah, let's go ahead and get into it. I think we can kind of start with some like basic podcast introduction kind of thing. Like if whatever you want to say without doxing yourself, obviously, kind of your early background and kind of how you got into trading and kind of what things early on in your life were influential in terms of leading you to trading.
Okay, sure. It's a loaded question, but I think we got 40 minutes here. So for those of you that don't know, I have been trading options full time for 16 years now. It's been my career. I'm super passionate about it. And besides option trading, I've got a passion for both technical analysis and teaching. I love to teach almost as much as I love TA. With that said, how did I get started? Okay, let's start from the beginning. I mean, I'm from South Africa originally. My dad was in the diamond industry for a long time. It was kind of a tough love thing to where he wanted me to work. He never gave me anything for free. So I ended up immigrating to the States and then going back to Africa and getting my diamond dealer's license from the Oppenheimer Institutes. And I think that's really helped me in my trading because in my early years when I was doing that, it was about trading diamonds, right? Diamonds had a market that went up and down. You had to be able to analyze them. There was bigger risks. I could go ahead and buy a polished diamond or a rough diamond that had more potential reward. Anyways, long story short, I made a good deal of money in the diamond industry, but it wasn't sufficient, going back to South Africa and coming back here and doing that. So I found myself quitting that industry, being in the United States and really having no skill set. So I had saved up some money. I was using it. It was dwindling down and I was kind of hopeless. I didn't have a direction to go. And it was kind of, divine intervention. I found a mentor in my gym. I started working out with him and he ended up being one of the top option traders in the nation with 20 years experience. And at one point he approached me and he asked me if I wanted to join him in this little group that he's opening up. And it was about trading stocks. And at the time, Will, I actually didn't even know what a stock was, let alone options. I literally didn't even know that a stock was companies, right, that have gone public. But the thing is I looked at this guy and I analyzed him and he had the exact lifestyle that I wanted. He had the nice cars, he had the big house, the nice wife and everything like that. And I knew that I wanted his lifestyle because it seemed like he made his own time. And so I sat down with him. I went to dinner with him and I said to him, listen, man, I'm in a situation where I need to find something to do. So I don't want to just join your group to make money. I want you to teach me. He was a lot older than me. And that was the beginning of a best friendship that I made with this guy that ended up being a long-term mentor of mine. That is how I got into options because he was strictly an option trader. In fact, the first few trades that I ever made wasn't even buying stock. It was actually putting on pure option trades. One of the things that drew me to options and what he was teaching me was the way that we were able to define risk. He came up to me and he said to me, what would you say if I told you that we could put on a position on stocks where we had unlimited upside potential and a maximum risk of 10%, meaning that if the stocks dropped to zero, all we would lose was 10%. Would you say that was a good deal? And I was like, wait a minute. So you're saying worst case scenario, I'll lose 10%. Best case scenario, I could double, triple my money. He goes, pretty much. And that's where I got stuck into options. He was much smarter than he doubted that I could learn it. Actually, he actually told me that you're probably not going to be able to do this like I'm going to do it. And that kind of lit a fire in me. So, yeah, every weekends, when my friends were going out, and at the time, I think I was about 20 years old. So I was actually your age. And every single weekend while my friends were going out and partying and drinking and having fun, I was at Barnes and Noble's, Adderall out, reading book after book. I was a miser, so I didn't want to buy the damn book. So I got thrown out of Barnes and Noble's at, 10 to 12 o'clock, depending on which Barnes and Noble's I was at. And I was learning everything, right? So I would tape record the dude where we would have conversations, and then I would pick out the words I didn't understand and try and find books. So I really started from the ground up and developed a love for options itself. And that was the mentor that got me into options. What I didn't have at the time was a real understanding of price action as far as the actual spot goes, right? I was into derivatives. And I think that's why I'm such an expert at options, is because that was actually my base. Then later out down on the road, I ended up splitting up from that guy, starting, doing my own thing. It's funny because then I contacted him like 5 years later, and he had a hedge fund with, $500 million in this hedge fund, and told me that I had left at the wrong time. Needless to say, I went on my journey. I found more mentors. My next mentor was the VP of Merrill Lynch. I worked hard to get that mentor, but he was my next mentor. And the most distinguishing thing with him was that he didn't trade options at all. And, just learning all this stuff for the past, 3 or 4 years, I thought that was the mecca, that, all the experts, all they did was trade options, right? That was like what everyone wants to kind of get to. No, this guy was a big manager. He managed all the big clients from Bank of America, and he was strictly a price action trader, value investor. So that's where I got into learning about stocks and price action, and kind of getting more into TA. Right? He really did bless me with a lot of great information. Like, he would keep me on his lists that he emailed and corresponded with these most high profile clients, right? To kind of let them know what was happening in the markets. So I got to see how he reacted during like the recession of 2007 and 8. At the time of 2007 and 8, really, it was really cool because I was running an option strategy that I designed. And what it was doing was basically buying stocks and then buying an insurance for like a year out, and then selling calls to offset that insurance. So I think a good place to start here would maybe be explain to the users what a call option and a put option is. I think I saw a lot of those questions on your tweet that you mentioned about this interview. So a call option, guys, what it is, if you're buying puts and calls, a call option is basically a bet to the upside, right? Just like you're going to take a leverage bet. It's a derivative of the asset. So that's how you long an asset, right? In options, is you buy call options. I'm not really a fan of buying call options because my whole life I've been a net seller of options. What I am a fan of is buying put options. What put options are, for those listening, and you should listen up close because it's my favorite aspect of options, is a way to insure yourself, right? And the best way I can explain it is kind of tell you that, like, pretend you had a car. Yeah. So if you had a car and you had this nice car, let's say it was a Corvette or something, and it was your pride and joy, and you bought insurance on this car, and every month you paid off this insurance, right? You paid off the monthly note, you paid off the insurance. If you had to wreck that car and total that car, what would your risk be on that investment? Your risk would be, well, not the car, because, hypothetically, they're going to buy you a new car. So your risk is actually the money that you've been paying every month to the insurance. That's what you would lose out if that was an investment. And that's exactly what put options are. The car is the stock. So you can have a stock. If the stock dropped to zero and you owned a put option, the most you would lose is the money you actually paid for that put option, just like you would pay for insurance on a car. When is the best time to maybe buy put options? Well, if you look at the stock market right now, I look at implied volatility. So you got something like in the stock market called the VIX, and I'm sure we'll get something like this. I think we have different forms of volatility on Bitcoin, but I think it's not implied. I think we do have implied volatility if you look at derivative, but for the most part, I think they look at historical. But when you want to buy put options or even call options, you want to do it when implied volatility is low. Like for instance, right now, and I'm kind of going off a tangent, jumping everywhere, but on the stock market has jumped really, really high. I mean, it just soared, and I've been long in the stock market. I've been loving it. But what I like to do all the time is the higher an asset goes, the cheaper the options get, because the lower the volatility gets. Like right now, if you guys are listening to me and you pull up a chart of the VIX, that'll tell you the volatility on the S&P 500. And right now it's very low because the stocks have just been climbing, right? And as they climb, volatility goes down. So now I'm actually looking at maybe I should be buying put options to, for 6 to maybe 12 months out. And it's the same thing if you're trading Bitcoin, and you're trying to trade options on those things. You want to look at that implied volatility, and options are cheap when it's low and they're expensive when it's high. So normally you want to buy when the VIX is low or volatility is low, and you want to sell when it's high so you can get a good premium in there.
Yeah, John, I want to hop in and just cut you off real quick.
Sorry. Yeah.
No, you're good. So I was just wondering for listeners, how can they utilize options to not necessarily speculate, but perhaps to, do like a covered call strategy and generate some yield? Like in what ways can people use options aside from just solely speculating?
Sure. So I think you hit the nail on the head. I think that if you're starting off in option trading, look, I really view buying call options as almost a loser's game. You really have to be good at what you're trading. You have to be right, and that's why I've become such a fundy on technical analysis. The reason why, and I'll stick with just buying real quick. The reason why you want to not buy call options very often is that to be profitable, the price action actually has to climb faster than the option is decaying, than theta is decaying, and that most of the time does not happen. So how can they utilize them proficiently? A covered call is a very, very great way to start, whether you're in stocks or in Bitcoin. What is a covered call? Well, a covered call is when you own the asset, whether it be a stock or Bitcoin, and you're basically going to pick a level that you don't think that Bitcoin might reach, right? So let's say it's at what is it at now? 46,000. Let's say you don't think that it's going to reach 50,000 by the end of the month, right? So you can take a bet with your broker, and you can say, hey, guess what? I'm going to bet you that it's not going to go above 50,000. And if it doesn't go above 50,000, you're going to pay me $1,000 or whatever the premium is. And that's what selling a call option is. It's taking a bet that the price action won't go above a certain level.
And what is, just for listeners, what is the premium, and how would you kind of, describe that in like a easy to understand way?
Sure. So the premium is what you get for taking the bet, right? So if you and I were to take a bet, Will, and we were just to say, hey, you know what, let's take a bet. I bet you that Bitcoin doesn't go above 50,000. You would say, okay, well, if I'm right, what are you going to pay me? That's the premium. The premium is what you get for taking that bet, because on the other side, if you sell that call option, if you have a covered call option and the asset does go above your strike price is where you think that it's not going to go above that $50,000 level. So if it does hypothetically go above that $50,000 level, you're going to now have to give your Bitcoin up at that $50,000 level, even though it might have gone to hypothetically 60,000. So you wouldn't necessarily lose money, you would lose potential profit. And that's what I love about a covered call, is that the risk versus reward profile is pretty good, because you really can't lose money. You can just lose potential profit if the asset had to climb higher. So you might say, damn it, I have to give my Bitcoin up at 50K and it's worth 60K. But you know what? You also have to take into account the premium that you got. So if you got $2,000 on that premium, your cost basis is actually 52,000. Right. So that's the upsides and the downsides of a covered call. There's not much risk, but if you're wrong, you might have to give your Bitcoin up. This is a good trade to make if you see potential weakness in Bitcoin coming up, right? So you've got some indicators, those are some setups, like you see my reversal setups and my topping setups. Those are times where I might consider selling a covered call. But I'll be honest, when it comes to Bitcoin, especially in a bull market, I probably would advise selling covered calls, right? Or if you're going to do that, at least wait and make sure that the implied volatility is high enough to where you're getting paid a decent amount for the risk that the risk of losing that potential profit.
Got it. And so when you're talking about volatility there, you're basically saying that volatility is cheap, right? When you're talking about the volatility is low relative to where you think it should be. And so like how do you see the options pricing in Bitcoin? I think you've told me a few times that you think it's a bit inefficient, at least on Ledger X, and kind of like the way they price in the options. Just kind of talk through your thought process there, and then also like what has to happen for it to get to the point that you feel comfortable? Is it just a liquidity issue or what?
Sure. So let me start off by saying that I absolutely love the people at Ledger X. They treat me great, and they are the only exchange that I've seen that has taken an effort, at least to listen to people like me, to help improve the option market. So now let's talk about the inefficiencies of the option market when it comes to cryptocurrencies. So in stocks, it's not that bad because it closes at 3 p.m. Central Time, right? So you can have your options on the line closing before 3 p.m. or whatever the case may be. Or if you go to sleep, at least you wake up the next morning kind of expecting what might happen, right? But in cryptocurrencies, you have a market that runs 24/7. So it's very imperative that you're able to define your risk. And in stocks, you're able to do that. You're actually able to put a stop loss on your options. So if you sell that call, right, or if you sell a naked call, which is even more risky, right? I won't get into that, but you're able to set a stop loss to define your risk. And options can be extremely risky if you sell them naked. Naked meaning you don't own the asset and you're just trading options like I did with my original mentor. Cryptocurrencies, for some reason, does not offer stop losses. And it's a market that runs 24/7. So while you're sleeping, you have this risk that you can't take off the table. So that is my biggest gripe. And when I was the educator for FTX, when they had an option exchange, I kept asking them to change this. So that's one of the biggest flaws, is that I'm waiting for an exchange to come and give us stop losses so that I can actually implement my own strategies, which are very, very, I have to be able to define my risk. That's like my whole sauce and everything that I do. You have to have a good risk versus reward ratio. So that is the biggest problem that I see. Other than that, there's also a problem with the spreads. The spreads are so wide that it almost makes it not feasible to trade options, because you might get in at a good entry, but getting out, you might, the spreads might be so big that even if you're profitable, you might just break even, in a best case scenario. That I think will get better over time. As the market cap increases, those spreads will get better because more liquidity will come into the market. The other problem that I have, and maybe a lot of people don't know about this, but there's actually, like in stocks, there's the Black-Scholes model that they price options. It's how they price options. The problem in cryptocurrency is that a lot of people don't know is that, from what I understand and what I've heard from insiders, is that every exchange has their own way to calculate how they price options. And if I'm wrong, if any exchanges are listening, please reach out and let me know, and I'll clarify that. But from what my understanding, it's not a Black-Scholes model across the board. It's kind of like everyone tries to make up their own pricing model. I remember when I called one of these exchanges, when I was a beta tester for one of these exchanges, I won't mention who it is, and I called him up and I said, listen, this doesn't make sense to me. Like, how are you pricing these options? Nobody could give me an answer. I went all the way up the ladder, and the person at the highest point of the ladder says, oh, well, we kind of price them like derivative prices them, which, is not giving me an answer. So for that reason, because I know I've talked to you a lot and you keep asking me like, okay, well, how does the option market, look for Bitcoin? And can you analyze that and tell me what's going on? And every time you've asked me that, I've given you kind of a lame answer. And the reason is because I have to be passionate about what I'm doing to be able to be immersed in it. And because I can't trade it, I'm not watching the option market as much. And quite frankly, I can make just as much money on price action alone because Bitcoin is so volatile, right? Catching these moves. So I hope that gives you an answer. I do hope that the option market gets better. I tell you what, I have been working with Zach at Ledger X, and that's why I give them so much credit. We've been talking back and forth, and I've been helping them actually try to design how to make the stop losses, because it is kind of hard, how to execute. What is the trigger on the bid, the mid, or the ask? If it triggers on the bid, you got, on the ask, you got room for manipulation. So it is hard. But those are the reasons, Will, that I don't touch the option market when it comes to crypto. And I'm very excited whenever we do get those stop losses, because that'll be my entry into back into the option market. But for now, my option trading is strictly on the SPX. I do it 3 times a week, and it's how I derive income.
Got it. And I kind of want to transition to like, you know, kind of give you an opportunity to plug yourself in here too. Kind of walk through some of these indicators that you're always posting on Twitter. I think people, are always seeing these arrows. They see like these reversal bars, and they don't really know what to make of it. Can you kind of just, I guess, give a one-on-one on some of these indicators that you've created, and also, how did you create them? Did you code them yourself?
Yeah, so interesting question. And you know what? I don't talk about this a lot enough, because I just like to teach, man. And the indicators really have taken off. It's probably had the most growth out of most of the indicators most companies this last 6 months. How did I come up with it? Well, these are simply strategies, Will, that I've been using for like, I wouldn't say 16 years, but I would say at least the last 10 years. These are my go-to strategies, right? These are setups that have a really high risk versus reward profile. And I came up with them because when I came to Twitter, people started listening to me. I started getting a following. And then I realized that I could probably reach out to some developers that can help me improve the indicators that I use to catch these setups. Like, for instance, I have one indicator that catches the volatility squeezes, which is what you talk about a lot, right? This is what's pretty much been the story of Bitcoin. If you can catch the volatility squeezes, it's pretty much directed everything. I came up with the volatility squeezes. It wasn't me. It was actually John Bollinger, another one of the guys I consider a mentor of mine. He's allowed me to keep open contact with him. Comes down to Texas and flies his little, tail dragger. For those of you that don't know, I love planes. I restore them. He was the one that got me into trading volatility. And I used his Bollinger Bands to do so. And whenever they pinch together, it gives you an idea that volatility might be building up. The problem was—
Would you say what Bollinger Bands are, just for listeners, just the
sure.
basic premise of them?
Oh, sure. Yeah. So shoot, I hope John's listening to him. He's my spirit animal, man. I love that guy. Bollinger Bands measure historical volatility, and they're based off of a 20-period moving average, which, if you guys have Bollinger Bands on your screen, if you want to put it up on your chart right now, you'll notice that there's 3 bands: as an upper, a mid, and a lower. They're based off of that mid band, which is your 20-period moving average, which is a lovely average that I like, because a lot of times in an uptrend, an asset will pull back to that 20-period moving average and then bounce. But basically, it measures historical volatility, right? So when things are above the band, you can say that they're overbought. When they're below the band, they're oversold. What people don't realize is the actual statistics is that when a price action is above the bands, it means that it's only above the bands around 10% of the time. So it's a very valuable piece of information whenever a price action is above those bands, because relatively it's only, in that situation 10% of the time. So it gives you a lot of ideas of either it's overbought or you've got a really strong asset, right? And that's for you to kind of decipher. But the thing is that when I was using the bands, it was very hard for me to decipher when these volatility squeezes would work. And I realized that if I was able to catch them, it was very, very profitable. And that's where I started looking into trying to changing the calculations and kind of making it better and getting a better visual, not for others. At this time, it was specifically for myself to help me better identify these setups. So what I did was I started to reach out on Twitter to find developers that could help take what I'm trying to develop in my mind into code and onto a chart. And that's how my indicators got started. They didn't get started because I wanted to sell them. They got started because I wanted a better way to enter my setups. And through that process, I started to share some of my charts. And before you know it, a lot of people asked me for the indicators. I shared them with some people. And eventually I said, you know what? Let me try and sell them. And I was a little bit hesitant at first, because I know that, if it gets too much adoption, that it can kind of skew the setups. But I actually talked to Bollinger and a few guys about that. And I don't think that's going to happen. So then I went forward more, and I developed some more indicators. The most popular one being the alpha trend. This is the one that I use, that Shardy uses. And that one will show you reversals, tops. And, long story short, well, it's just all my setups that I've used in my whole trading career. I told you I love teaching as well. So it's been a really fun experience for me now offering them to people, because I also get to answer questions and help people. And it's had a lot of great success. So like if you guys go to my handle on Twitter, it's called Trading Alpha _. And that's my company there. You'll see we get really great feedback there. And if you guys want to check the indicators out themselves, it is available directly from the website, tradingalpha.io. Go check it out. I do have a bunch of tutorials as well that can really, really help people too. But in a nutshell, Will, I appreciate you helping me plug my indicators, and that's how they got started and what they do.
Got it. So like, I use the volatility squeezes, and as you mentioned, I'm posted them on Twitter a fair amount. But like, quite frankly, I don't understand like what causes that orange shading. Is it when the bands get to like a certain distance from each other, or kind of help me understand that?
Sure. So I'll tell you this much. That's part of it. Right. So if you had to take, Bollinger Bands, and you had to try and quantify the pinches and try to, identify the squeezes, what you'll realize is my shading squeezes do not match up with the pinches. That's because I've taken some other proprietary information that I've learned over the years to help me better identify these, because it really is undervalued, Will. Along the lines, I got more mentors and got connected with more funds. And what I found was, there's this cycle analysis originally laid out by Stan Weinstein. So if you guys want to read books by Stan Weinstein, he's a legend. But it goes over cycle analysis, where basically you have consolidation, and then after consolidation, that's your stage one basing, and then you get a stage two uptrend, right? And this is the mecca of trading. This is what everyone tries to catch, is your stage two uptrends. Long story short, there's probably not enough time in the video to go through this, but those volatility squeezes happen when you're in a stage one basing. And if you get a breakout from those stage one basings, that puts you in a stage two uptrend. And just to give some reference to this, at $9,000 on Bitcoin last year was when we went through our first squeeze breakout that put us into a stage two uptrend. I did tweet it, and that was my best trade that I made all year, was getting into that stage two uptrends. And that's exactly what these squeezes do. Another example would be at $30,000 just recently, when you were talking about, your supply shock, which, we can get to that too, how they kind of synced up. That was really, really cool. The supply shock was happening. So I got the macro view from Will that, overall things are bullish. And then we kind of get squeezes at that $30,000 level where there was consolidation. That puts you into a stage two uptrend. So I tweeted that entry from 30,000. That took us all the way up to $50,000. That was a stage two uptrend, right? That's what you're trying to catch. And that's the whole point of volatility squeeze breakouts. It's funny. I have these economists that, again, long story short, there's this one economist. He's one of the best economists in the world. Happened to be my best friend that I grew up with. She's a female, ended up being marrying this guy, and then we became best friends. And he's one of the guys where he works for one of the bigger hedge fund guys around. And this guy plays stage two breakouts, stage two uptrends, but not with volatility squeezes. And the first time I explained to him volatility squeezes and brought him through the scenario of how it actually identifies those stage two uptrends better than they do, he was completely shocked. And he said to me, have you told anybody about this? And I'd already mentioned it on Twitter and kind of told people that. I said, yeah, I've told people, but I don't think that it's really, I don't think they get it. I don't think they understand the value of it, but that's what the squeezes are. The whole point is to catch those stage two uptrends. Well,
got it. And yeah, like you touched on this, it was really cool to kind of see that synergy between what I was describing as a supply squeeze, and basically had, from an on-chain perspective, this massive reaccumulation of coins, right? We had this drawdown in May, where price was kind of trending sideways bearish. But meanwhile, when you looked at some of these metrics that I used to identify accumulation, you had a complete divergence in those things. And so from my perspective, I was watching for some kind of supply shock effect eventually that would come on the market. And at the same time, I think this is actually right around when we met each other, and you were just talking about this. You just, we're going to town on the whole volatility squeeze thing that you were waiting for, and you're like, yeah, well, I'm waiting for this this stage 2 breakout. And I was like, well, hey, like, hold on a second. Like, this is kind of interesting here, because we're both basically talking about, something similar, just using a different language to describe it. Right. And so I think it's been really cool to see that, synergy between the two. And I think this is definitely something that I'm going to be using moving forward. Like, I think for listeners, like, whenever they hear me talk, I do like these weekly newsletter overviews now. It's always from an on-chain perspective. But, these are things that you can use in combination with each other. And like, what you want to look for in, as a trader, is something called confluence, right? You want to see, consistency across multiple, preferably uncorrelated indicators. And if they're all kind of telling you a similar story, then, statistically, the likelihood of something like that happening is much higher.
Yeah, absolutely. And that was a great moment for me. It's funny. Well, so in a regular fund, you have economists that the hedge fund hires, and they give the economist the macro backdrop, which is the longer term outlook. And then it's up to the hedge fund to either have now technical analysts. A lot of times the fund manager will be the technical analyst. He'll look for the price action on the short term to validate the long-term macro. And then boom, that's how a fund works. And that's how I've been getting my information, was from economists. Will, I don't know if you realize it, but you're the economist in the crypto world. You're that guy. Because, and I want to clarify this, because I do see a lot of people giving you shit, especially from the crash that happened. Oh, well, how come on-chain didn't do this? For those of you listening, you're not looking at the picture right. Will gives you the macro backdrop. It's up to you then to take that macro backdrop and look for shorter term setups within a bull market, right? It's the same thing as looking at your chart on the weekly time frame and saying, okay, we're in a bullish market. It's time to look for better setups on a lower time frame. So for those of you guys that follow Will, please don't give him shit. We're so lucky to have this guy, Will. And I'll tell you another thing. Back in the day, the experts were the guys that had the extra information. And we've talked about this in the spaces before. So like, for instance, when you went to a doctor back in the day, you didn't know shit. You rocked up at the doctor, you were scared, and he told you exactly what was happening, and you followed him word by word, and you went home and did it T to T, right? Because the experts were the people worth extra knowledge. But these days it's changed. Anyone can get that knowledge. You can go on the internet and find anything you want to, find. That's why people go to doctors now. And, before the doctor gets a chance to talk, the patient is telling them what they have and what they want, and judging the doctor by how he reacts. Right. So then it comes down to, the experts aren't the people with the extra knowledge. It's actually the people that can take that information and curate it the best, meaning explain it to people the best. The doctors that are good now are the ones that have the good bedside manner and can break down what you've read. That's what you are, Will. You curate the information so well, and you speak so elegantly. I'm really looking forward to seeing how your future unfolds. And anyone that's watching you, please don't give Will any shit, because I'm learning from you, Will. Like, as I said, you're like my economist for the crypto world. So kudos to that. And just, don't get down by those guys. They just don't understand it. And I'm learning a lot from you. And that's exactly how I'm treating the on-chain stuff. So when I jump in those spaces and I'm listening and I'm learning from you guys, that's kind of like what my game plan is to try and listen to these supply shock theories and stuff like that. And yes, it's beautiful how that happens. So anytime there's another supply shock coming, Will, in the future, please sure to, dial my line and let me know, and we can figure this out with another squeeze.
Yeah, for sure. We kind of touched on macro there. I'm just curious, your kind of general thoughts about macro, and I know that's not like your, specific, expertise necessarily, but do you have any thoughts there?
So you're asking, because remember, I trade many markets. So you're talking about the crypto market, right?
No, just in general, just like global macro.
Man.
And okay, I'll word it this way. How do you think global macro, sets up a favorable environment for Bitcoin?
Well, I'm laughing because I'm trying to decide like how much I want to say here. Because as I said, I talk to economists and they tell me some crazy shit. I'm just going to drop it. Like all the economists that I talk to think that we're in the middle of a Cold War right now. So that's kind of their framework of is like looking back at different types of Cold Wars and kind of seeing how the markets reacted. For instance, back in World War II, we actually had a melt up in the market, and believe it or not, equities actually melted up. Which was very interesting. And an economist, my friend, told me about this about 8 months ago, that he thought that we were going through this environment and that equity should melt up. And that's kind of what's happening right now, and we've seen happen, right? And sure, that's also because of the Fed. I see the backdrop when I talk to these economists. They all tell me that they think that the best place for money right now, believe it or not, is Bitcoin. When they look at everything, right? Fundamentally, we don't know how long equities is going to go up. I think I talked about this last night. For me, it's going to be very interesting. I'm waiting for a moment for Bitcoin to really become a risk-off asset. And the only thing stopping it from becoming a risk-off asset is the fact that the volatility is so intense that it's hard for these institutions to wrap their mind around going into the asset. But the fact of the matter is that if equities do crash and bonds are crap, there might come a moment to where this is the place. This is the only place to invest. So for a macro backdrop, to answer your question, Will, I don't think we've ever been in a better situations for crypto specifically to shine. And that's why it's very hard for me to get on board with anybody talking bearish right now. As you know, when we had that crash, I was very lucky to get some stink bids filled. There wasn't big positions, but I still had that position on, and I'm playing it as a mean reversion trade. And what are we at right now? Let's see. What's the price at? Is it about 47? Right? Yeah, exactly. So that's how I'm playing it, Will. I think that we're in a good spot. I think macro, it's never been better. I mean, we've had El Salvador, adopt Bitcoin as legal tender. I do think that it was a sell the news event that we had with that crash. But look how it's reacted since. I mean, it's climbing back up. So
the 200-day has held really well, which for me, that's kind of like, yes. To me, that's showing the boomers are feeling confident.
Yes. In fact, I've talked about this a lot. That's actually my line in the sand for keeping me kind of bullish or bearish is staying. Because right now, I think we're like right on that 200-day moving average. And one of my indicators actually just had a bullish reversal bar today off of the 200-day moving average. So I really think that it's not going to be too long till we're back to, 54,000, trying to get over that hump right there.
Yeah, and like this whole move was pretty much just all like, liquidation cascade, right? Like in the stuff I look at, which I consider basically the fundamentals, right? Like you didn't see anything that changed in terms of the broader structure of the market. Actually, what I found really interesting was you saw whales really increase their holdings on the same day. And then you also saw what I consider as the strong hands in the market. Their holdings increased as well. You also saw exchange balances go down. So it's like, the noise is, we drew down because we had a bunch of leverage in the system that got unwound, right? Like open interest was way up. Funding was slightly positive. It wasn't insanely positive. So I was a little caught off guard, to be honest, by the move, but it was positive. And then we got that reset back down into, negative territory. But yeah, like it wasn't any, fundamental investors that were, panic selling or anything like that. It was just all derivatives. So yeah, like I think it's just another, just Bitcoin has these basically cleansings, right? Like if you look at the chart from March of 2020 to March of this year, we had like 20% drawdowns. And most of those were just, liquidation, cascades and just leverage wipeouts like we had the other day. So yeah, I think like, you see a lot of panic on Twitter and all this stuff. And like you said, it's just like the perfect opportunity for mean reversion because there's no fundamental reason why the price went down aside from just the fact that, it was just a bunch of forced sellers in the market.
100%, and it's just the smart money. Like, as you say, the smart money is accumulating because if you actually look at the situation of what happened, right, if you try and analyze it and just be problematic about it. So you had El Salvador and everyone knew that they were going to adopt it as legal tender that day. So what you can assume is you probably had a bunch of people getting leveraged longs thinking that this was really going to be, how long have we waited for a sovereign country to adopt Bitcoin, right? So you can guarantee yourself that there was some people, even some institutions that took some very leveraged longs and said, you know what, this is a good risk versus reward, right? So then you had those guys. And then when it happened, you kind of didn't see the reaction that everyone wanted. Yes, it was climbing up steadily. But obviously somebody took those positions off and went short, right? A big player. And when he went short, you had all those other guys that were all leveraged long, still expecting a good news event from this. So, I mean, that's all it was. I agree with you 100%. Nothing in the fundamentals changed. It was simply a one-off event where some people were leveraged long because of the El Salvador, and they got extremely liquidated because somebody even bigger took the position off and actually went short because they realized that they weren't getting the reaction they wanted. It's pretty cut and dry to me. And now we're back to where we were, which is in a great macro environment. In fact, looking at the screen right now, we're still in that zone of the squeeze. In fact, we might even break. You might even see another shading squeeze here in a couple of days if price action kind of consolidates. So I think we're right back to where we started. And, it just took a little bit of Bitcoin from some people, and the smart money accumulated, like you said.
Yeah, for sure. And just kind of as a final question, do you have any, like long-term Bitcoin thesis aside from, you just kind of touched on some of your thoughts on global macro, but as far as like, the protocol itself, and also like, are you a hardcore, like, Bitcoin maximalist, which I'm just curious, I'm not like a crazy Bitcoin maximalist where I'm going to like, curse people out for holding altcoins or anything. I'm just kind of curious. Do you have any thoughts there in terms of like, other projects that kind of catch your eye or anything?
Sure. So, I go with probabilities, right? I'm a trader. So to me, I've spent all my years trying to take the emotion out of my decisions and just trying to be logical and, bring it down to the numbers. So for me, it's a probability game. I'm a little bit too big to play the small caps, right? And I'm not like a pump and dump guy. You never see me shilling any shit coins. So for me, my long-term bags are mostly Bitcoin. Then it's Ethereum. I've got some Sol. I've got some Matic. But yeah, no, but Bitcoin has really taken my heart. As I said, I've been trying to be as unemotional as I can through my trading career. But I can say I've probably never really become as attached as I have to Bitcoin, right? It's kind of hard to not get attached with the narratives and the potentials that it has. So no, I'm not a maximalist, but I do have a HODL bag that I look for setups, and then I'll add to my HODL bag, and I probably won't sell that for 5 to 10 years. I'm in a situation to where I make enough money to where, and that's a thing, right? Is I think that sizing is a big thing for people whenever they buy their HODL bags is they can get a little bit greedy and buy positions too big. And if they buy positions too big, then short-term crashes will shake them out. So kind of deviating from your question there, but I really think that a big piece of advice for people getting into Bitcoin is just make sure that you size your position appropriately and realize that, if it has to go through a 60-70% drawdown, is your position sizing small enough to where that won't affect your lifestyle? But to answer your question, Will, I'm as far as I can be towards being a Bitcoin maximalist, but I'll always keep my identity as a trader, right? And being sensible about it and staying diligent. So.
No, yeah, for sure. And like, I'm just curious, do you denominate those altcoin bags in Bitcoin? Because just from like, I'm just thinking about from a risk perspective, you're always talking about risk, right? It doesn't really make sense to go out and, buy some coin with higher beta, right? If it's not going to outperform Bitcoin because you're taking on unnecessary risk where Bitcoin is way lower risk, and you're getting the same return. Do you just denominate in a USD basis, or do you use that Bitcoin?
Well, more so what I do is I like to categorize things that have, what's the word, relative strength, right? So for instance, there will be a period of time when we get into a bull market where I will look to get into some other coins that have higher volatility, right? And they're probably coins that people would never think that I would trade. Like I've done this on XRP, I've done this on Litecoin, but the whole reason for it is because with more volatility in the right setup, you can catch much bigger returns and then obviously yield more Bitcoin, once you go back into it. But that's how I kind of look at it. I look at it from a relative strength basis. So I do have a chart where I'm tracking all the coins and, their movements and how well they're doing. Like for instance, right now, obviously Sol has the most relative strength in the market, right? It's just it's just killing everything.
Crazy.
Right? Dude. Yeah. You know, and it's hard because people are looking at that. And I know it's like a competitor to Ethereum, and they're looking at that price action. They're thinking, you know, should I buy it now? Is it too high up? And, you know, that's the thing. Right. And that's why I'm all about setups. And that's why I really, you know, live and die by my indicators, because right now, if you look at SOL, it's so high up. The further it gets away from that initial breakout, the bigger your risk is, right? Like, where would you set a stop loss in that chart? Like, you know,
there's no structure at all.
There's no structure. We're past that, right? So that's the thing is, and that's another reason going back to those stage 2 breakouts, when you can identify, because that was a stage 2 breakout. In fact, let me pull it up if you don't mind. Let me just look at that. I bet you went through a volatility squeeze that you could have caught that from the very bottom. Let me see real quick here. FTX. Okay. Yep. I believe we had one at $36. So
been nice to catch that one.
Yeah, that was actually the start of the stage 2 uptrend. And after stage 2, it goes into a stage 3 basing, which is right before your stage 4 downtrend. We haven't even seen a stage 3 basing. So yeah, this has all been a stage 2 uptrend. But yeah, Will, to answer your question, to get back to your question, I just look at it more so rather than denominating in Bitcoin. I just look at it from a relative strength basis, and that's how I decide to rotate. Right.
Got it. And yeah, I just want to kind of give you an opportunity to plug yourself in, your indicators, and, you know, if you have any kind of final thoughts that you wanted to get out.
Yeah, sure, man. I'll tell you what, I can plug the indicators, but let's first start with, I did get a lot of questions. Probably the biggest question that I got DM'd to me is like, what advice would I give to anyone that wants to start trading full-time, right? Because I think that's like the hopes of a lot of people. Trading has really taken off since this COVID environment started. And the best advice I can give to people that really want to make this full-time is it's really hard. For the first thing you got to do is you really, really have to find a mentor. You really, really have to find a mentor, get them to like you and get them to give them some of your time. And that happens from you showing the mentors that, you know, that you're going to be persistent. You're going to, you know, you're not going to give up. You're going to actually take this seriously. The next thing I would say is you're probably not ready to make this a full-time career. You really need a big bag, right? A lot of people get greedy and they think they can turn, you know, $10,000 into 100,000, which might be possible. But what you should really do is you should really have a steady income coming in, save up a lot of money. And once you're at that point, you know, then try and make a trade plan and get that mentor. Another big piece of advice that I would give that I see people making mistakes a lot of times is there's so many ways to make money in trading, right? It's not just my indicators and my setups. There's hundreds of ways to make money and are completely legitimate ways. Like, well, one mentor was an option trader. The other one was just a price action trader. What you need to do is you need to not jump from method to method. I see a lot of people doing this. They'll give up on a strategy or method because they went through one drawdown. Then they'll jump to the next one because they saw someone on Twitter, you know, trading the Wyckoff method or whatever it may be. Right. So my biggest advice is to just take it slowly. A lot of you guys are young, you know, you've got time on your hands, and really learn these methods and give them all a fair chance before you give up on them. Because if you're going to make it a career, that means you found something and you know it back to front and it works for you. And if you never give anything a chance, you'll never get to that point. So find your mentor, make you a game plan. The two most important things in trading are your position sizing and your stop losses. You have to be able to define your risk. And have to be able to position have your position sizing accordingly. If it's too big, you're going to blow out. If it's too small, you're going to feel like all your trades weren't worthwhile. So that would be my biggest advice. Going into plugging myself, if you guys haven't followed me already, my Twitter handle is 0hedge_. And if you're interested in any of my tools, the volatility tools are the high time frame suite, the low time frame suite. Again, you can find those at tradingalpha.io. And you can also find our flagship indicator that a lot of the professional traders use on Twitter. It's called the Alpha Trend. That's going to give you all the reversals, all the tops. These are the two indicators that I use to catch that setup from 30,000 to 50,000, and also the setup from 9,000 all the way up to 60,000. And then it also called the crash from $63,000 down all the way. So those would be my two plugs, Will, and thank you for giving me the opportunity to get them out.
Yeah, for sure. So I'll just say everybody, you know, go check them out. I use all those indicators on my own Trading View account, and I follow them pretty closely. So yeah, thank you so much, John, for coming on. John is somebody that I look up to a lot. Try to keep in very close contact with because I really value his insights. And yeah, this was awesome. I'm sure the listeners are going to get a lot out of it. So yeah, thank you so much for coming on, John.
Hey, Will, thanks for having me and keep killing it, buddy.
Appreciate it. Take care.
Take care. Bye.